Right, good afternoon, everybody. Welcome to Roma's refurbishment webinar. I'm sure others will join us as we go along, but we'll crack on because we did say we'd start at 1 o'clock, so we'll keep on time. Yeah, so we'll run through we've got some slides for you in terms of where we sit in the market, in terms of refurbishment, and also we've got some examples to show you of completed cases, which should help us along as well. Okay, on to the next slide. So I think where we start in terms of where I would position your inquiries is getting to know and understand your borrower. Some of the important sorry, I've just been told, I must mention we're being recorded, so hopefully that's okay with everybody. I was told to mention it and I've forgotten, so so we'll run through the slides, and then I think it's probably best if you've got any questions, just keep them to the end if that's okay, and then we'll run through them. However many there are, we can cover those off. So okay, so understanding the borrower. I think it's important to understand sort of what motivates, what's their individual motivation, why are they in this property space, and also get to know their background experience, because obviously everybody has to start somewhere. So that's important, and you will see a wide range of people's background in terms of what they've been up to. Some start with very small projects and build up over time, and some keep to the same thing that they're good at just time and time again. Costs, timescales, very important these days. Obviously, rising costs in pretty much everything that we're doing at the moment, and timescales. Projects do get dragged out for various reasons. So be realistic with how long you think you can complete that project. I think it's always worthwhile probably adding an extra 3 months, particularly if there's an exit plan. Some of the lenders are very busy, and I hear that they are they're inundated with business, so always give them enough time to exit out of that deal without putting added pressure onto your client, really. So one of the key things that we say at Roma is that we actually will underwrite the individual, the person, before the properties, where other lenders may not. They might just dive in straight away to look at the property. So I think that's an important point to remember. So yeah, just touching on, so according to Mittal, back in 2020, refurbishments were pretty common in terms of a bridging loan. So 23% of customers use loans for this purpose. So, and we'll touch on actually, what is a refurbishment loan and the segmentation surrounding that. We'd love to lend. That's our motto. In terms of funding lines, we are as flexible as we can be. We've got 9 different funding lines for various transactions, various institutions, banking lines. So, we try and be as flexible and work with your clients, in all cases, really. It's so important that we get to know the customer and work with them. So, we're confident in most instances we can help your client out. So in terms of the products, we categorize them as follows. So you've got obviously standard bridging. So that's your standard purchase, where generally the applicant funds the deposit, and if there are works to be done, they will fund those works themselves. So in a standard sort of residential property, you're probably looking at 75% day one, and then they will fund those works in arrears themselves. So slightly less on semi-commercial, probably looking at 65% in commercial, around the same point. Now, following on from the bridging, we would still class a light, medium, heavy refurb as a bridge. However, the difference being is that we fund the works in arrears. So a typical light refurbishment from a residential house into, say, a HMO, we would fund 70% against the purchase price day one, and then 100% of those works to convert that property into a HMO. Now that varies. It could be sort of £20,000-30,000 sort of internal petitioning, toilet, shower facilities, and then you've got the other end of the scale is where they may do a particularly high-end job to attract that type of tenant, professional tenant, so those works might be higher. So as long as you're 50%, we class a light refurb as up to 50% of the value of the property. So if you're purchasing that property, say for 200k, you've got up to £100,000 you could spend towards that property, and class that as a light refurb. Now, obviously, that's reflected in the pricing. So your pricing tends to be better on obviously a lighter compared to a medium and a heavy refurb. For obvious reasons, they become more risky the bigger the project. So it's sort of worth bearing in mind. 50% is quite a flexible approach in terms of where we sit in that market. So a medium refurb is probably something a little bit more complex. It could be a residential house that is being extended. It could be going into the roof. So quite a big project. So where that would sit is probably, it sits between 50 to 100% of the value of that property. So again, if you're buying a property, say for 200, and your works come in at sort of, where are we, 125, then that would sit in that sort of bracket. And then pricing tends to be a little bit more expensive, not massively, but it's obviously reflected on sort of the risk aspect in terms of where we sit. And then the far end of the scale is a heavy refurb, and this is quite common to commercial properties. Is a good example. You may have an office block which has planning in place to convert to residential flats. So significant work, the size of the project. So then, yeah, following on from the other two, a heavy refurb would be, so you bought that, the office block for £500,000, and then the works required, are 1.2 million. So that would be classed as a heavy refurb. So yeah, so we would obviously, in terms of all of these projects, we like a sort of breakdown of costs in terms of costs associated to that project itself, and also a time frame. And it's important to look at experience. We will lend to first-time people who are doing their first projects, but they need to have an experienced team around them who basically know what they're doing. So that's obviously important. So here we are, case study. This is a light refurb, which we touched on a few moments ago. This was a renovation to let. So you can see the customers purchased the two properties. You can see the before and after pictures there. And the intention was to obviously to renovate it and then to sort of to rent out. It was a bit of a short time frame to work to, so we achieved their goal in terms of they purchased the properties for 170, and then we provided an initial loan of 127,500 to assist with the purchase and those works, like we've just highlighted. There's a little bit of added complication. There was some gifted funds in the background, which we got comfortable with, and they helped towards the project. I think it's worth pointing out sort of EPC ratings are quite important these days, and what we're seeing is a lot of bridging cases come in because they're not up to the required standard, and they need certain works doing before they can exit onto as a lender, as a typical sort of buy-to-let. So yeah, going back to this one, the GDV was at 270. We completed the deal, and then they just exited onto a standard sort of buy-to-let mortgage as planned. Right, next one is sort of this is a damaged barn development, which was a repossession actually. I think whoever took it over sort of ran into sort of financial difficulties, may well have took on more than what they thought. And in the meantime, the property was vandalised and then it was repossessed by the lender. So it's probably in a bit of a state, as you can see, when it was taken over. So yeah, so our customers purchased the property for 215, and then we gave them a facility of 210. So that would probably pitch in sort of around sort of 65% day one, and then the additional funds we used to bring the property up to standard. The project lasted about a couple of months. Have to be careful sort of with barn conversion because there's a lot of building regulations that you need to follow. So they tend to be a little bit more complex. Hence why this developer may have run into difficulties initially, taking on something he wasn't probably experienced with. So yeah, so the GDV was achieved, and then the tenant sort of moved in pretty much straight away, and this created a profit of 30k in just over the 3 months. So in terms of bridging criteria, it's segmented there for you. You can see sort of where we sit in terms of rates and LTVs. LTVs are pretty much a strong guide as to where we sit in those markets. The rates are purely as a guide. We have flexibility in terms of rates and how we can structure them, whether we go in with a standard rate. Obviously, rates have increased, and we can include exit fees, whichever way you want to sort of structure the deal, really. So in terms of where we sit, in terms of commissions, we'll work with you, what you expect out of the deal, whether there's an additional sort of broker fee that we can also include within the deal. That doesn't affect the pricing, but your broker fee will affect the pricing depending on what level you receive. So the less you take, probably the more keener we can be with the pricing. But we'll work with you and whatever works with your client, really. So in terms of where we lend, obviously England, Wales, Scotland. In terms of what we lend against, obviously residential, HMOs, semi-commercial, commercial. We like to try and use AVMs if possible. There's an initial cost of £30. There's certain parameters that we work to on that, but if we can, we'll always go down that route and save your client money. And generally speaking, we always fund 100% of the works costing, but we have got certain parameters in terms of working against sort of 65% GDV. Generally, if a project's worth doing, then it has to be profitable, and generally speaking, we will always lend you 100% of those funds that are needed. What we do see also is that development to exit product is that once you've done a project with us, if it's been sold, we can actually move you over to that product, and it's actually a cheaper product. So it will actually save you and your client some money if that property is being sold. So that works well. And in terms of title insured, we try and use that as much as we can. We're obviously guided by solicitors ourselves, but that does help to speed the process up. So in terms of refurbishment, we've touched on this earlier. It's just a cap. So we class as a light refurb, just so you've got it in your minds, that up to 20% of the value. That sort of kicks into our Roma flow, and the Roma flow is it's basically a quick way of processing your cases through. There's restricted, limited sort of checks that we do. We use online checks. Things that go on in the background that you won't see, but will ultimately help the speed of the transaction from day one to completion. So there you go, light refurb, as I said, 20 to 50% of the open market, the current valuation. Medium is 50 to 100%, and then you've got your heavy refurb, as I said, is 100% of the current market value. So in terms of what we require, when we issue terms, we send out an AIP, an agreed in principle, for the client to sign. We need that, a completed application form. So we've got an editable document that's available. Valuation fee. When we know your client is going ahead, we ask and we request valuation quotes. Most of our quotes go through Method or VAS. And generally speaking, we ask for about 6 quotes. And that's dependent on who is available at that time in terms of the area, the type of valuation, etc. And it's also important, availability, how quickly they can get out to that property. So the report we get back highlights obviously the cost, but also importantly how quickly they can get out. And sometimes that's more important than the actual cost itself. So we've covered quite a bit there in terms of bridging light refurb. Are there any sort of questions, any sort of examples you've got, or anything you want to go through? Feel free to sort of to go ahead, fire away.
Hi, Mark.
Hi, Les. You all right?
Yeah, I'm good, thank you.
Good.
Just a question around a client I have who's in the process of acquiring probably 2 or 3 properties for refurbishment.
Yeah.
There'll be a range of light refurbishment with just tap and turn, or a single story extension, which will be within permitted development rights.
Yeah.
Or a 2-story extension, depending on the specific property. I'm assuming that as long as the costs fall within your definitions,
Yes.
then the fact that there's not the fact that it's a permitted development wouldn't require anything more from you. They wouldn't.
No, that's fine. As long as it's within that criteria, then fine. I mean,
It leads on to another question.
Yes.
So he's bought the property. He wants to go for planning for a 2-story extension.
Yeah.
Doesn't know with certainty whether he's going to get it yet. So the fallback would be just a single-story extension without having to go for planning.
Yeah.
How would you approach that in terms of what your agreement might?
I think it's best to structure it the preferred route. I think in terms of allow enough time, I would say. Make sure that you're not trying to do it within 6 months, because it probably isn't going to happen. So give you 12, 15 months even, because you can gain the planning, have it in place, and then potentially we could obviously assist with that deal during that period, and then obviously exit out.
If planning's not forthcoming, then obviously you just fall back to
exactly. So I think it's if we position it, this is the preferred route. However, if this doesn't materialize, this is the fallback route, and providing that still works, and we've covered both sides, no problem at all. We'd be happy with that.
And this chap has experience. He's done ground up development, so the fact that he's buying 3 at once potentially wouldn't be a problem for you.
No, not at all. No. I mean, we can fund. I mean, I would say it's probably best to fund them individually, because they're separate projects and they'll have different time frames. So no problem at all. If they all come in today, if they all come in at the same time or over a period of a month or whatever, then that's fine. It's not going to go against them in terms of what we can offer. So that's fine. Yeah.
Okay, perfect. Thank you.
Hi, Mark. It's Rob Quinn here. Thank you very much for that.
That's fine. Thank you.
I wanted to ask, for some of those, when you get these PD transactions proposals come through,
yes,
do you do the bridge and roll into the development finance and allow them not to do? Do you double quote them in terms of arrangement fee? If they did a bridge with you and there's a 2% in, and it rolled over into development finance, would you then expect another 2% to roll them into a different product?
What I would say, and I think it's the same with most lenders, is that we'll try and be as flexible as we can. And I think, you know, we're not going to be harsh on them in terms of charging them 2 lots of fees. However, the way we fund the transactions, the likelihood is that if you do a bridge to acquire the site to gain planning, for example, like Les has just referred to, then that's the likelihood is that's going to be a completely different funding line to the ground up development. So it depends. I mean, it could be that if we're able to do it in one transaction, fine. If it's not, then we will be as flexible as we can in terms of that. You know, the note that you've already. Basically, we're doing the exit, aren't we? In terms of, you know, if it does go on to ground up. So we'll work with you, and we're not avaricious in terms of fees. So we'll work with you and what works with your clients. Because it may be that, you know, you may not want so much out of the second transaction as you did initially, or we can just split it across the two. So yeah, we'll as I say, we're not avaricious, so we'll work with you really in terms of what works for you and your client.
Okay, thank you.
Thanks, Rob. Any more? Any more questions? Anything else you'd like to just run past me, or anything that's kicking around?
It's Les again, sorry.
That's all right.
Just something that occurred to me. You said about funding in arrears. I mean, if you're talking about, I don't know, 50,000 on a £200,000 property to do the development, how would that work in practice? How many drawdowns, for instance, would you expect? Or
we can be as flexible as you want. I mean, I would. The more drawdowns, obviously, it becomes more expensive. So I would sort of.
Many drawdowns on that.
Yeah, exactly. So if you can restrict them, it depends what cash the clients have got in the background, really. I think if you can restrict, you know, 2 is probably, it can work, you know, if it's a small drawdown facility, but ideally probably 3 and 4 drawdowns is probably where you want to be, unless it's a sizable, you know, it's a large complex and you know, a large deal itself, then you may get up to sort of 5 or so. But I would think probably, you know, 2, 3, 4 is probably where you want to sit. I wouldn't recommend any more than that, really.
And in terms of the drawdowns, what evidence are you going to need to permit a subsequent drawdown?
Yeah, it depends what it is. I mean, we don't always insist an inspection takes place. If it's, for example, kitchens, if it's quite clear that, you know, what can be evidenced in terms of kitchen, bathrooms, you know, internals, if that can be clearly evidenced by photos or a video, it may well be that's acceptable. But obviously, if it's structural, if it's, you know, if the building works have to be done to a certain level standard, then that type of thing needs to be inspected. Now, I think it doesn't always, you know, it's not only protecting the lender, it's protecting the investor, the client, also making sure that anything is certified and guaranteed. So that's reflected in the price, obviously, you know, going forward. So, but we you know, we work with the clients. It's not every time we insist on a site visit. So, you know, we can be as flexible as we can, really, on that.
Okay, great, thank you.
Okay, is that it? No more questions? Sounds like it. Okay, well, thank you for your time. If you want to get in touch with myself, my email address is it's mark.foley@romafinance.co.uk. My contact details are on the website if you haven't jogged it down. But yeah, just give me a shout if there's anything you come across, anything you want to chat through. More than happy to help. So, and thanks for your time. See you soon. Bye-bye.